So in 2019, we saw contrasting conditions in our two main markets, with our mining-focused market seeing continued positive conditions in terms of supportive commodity prices for our main exposures of copper, gold and iron ore, while in our oil and gas markets in North America unconventional space was more challenged through the year. So in the round, as we looked at the overall results, then orders for the group were up 8% on a reported basis, or down 4% on a like-for-like basis, excluding the full year impact of ESCO. Revenues were up 7% on a reported basis, or down 6% on a like-for-like basis, and profit before tax at £303 million was £7 million lower than last year, again reflecting the strong mining business performances offset by that weakness in oil and gas. Taking each of the divisions in turn, our minerals division, once again a strong performance there. Market conditions supportive on the aftermarket side. A little bit of caution from our customers on project activity, given macro concerns around trade and so on and so forth. But from our perspective, our business model once again allowed us to outperform those market conditions, with aftermarket orders up 5%, reflective of our market-leading service centre network with engineering capability on the ground, driving solutions for customers. And on the OE side, our approach now to integrated solutions, where we're packaging our different services and equipment to really provide solutions to our customers' strategic challenges of energy, water efficiency and maximising production. So that left OE orders up 22% year on year, with the highlight being our £100 million order for the Iron Bridge project in Western Australia, where we offered an innovative energy efficient solution to our customers' crushing project there. Looking at profitability of our minerals business, then operating profit was up £17 million to £270 million. That left operating margins up 50 basis points at 18.3%. Turning to ESCO, again a positive performance there, benefiting from both the same market conditions as the minerals division that I've described, but also the benefit of integration and the cost synergies that we've achieved. So that left revenues in ESCO up 5% year on year, and operating profits at £83 million were up £20 million on a pro forma basis relative to last year, and operating margins 14.5%. Actually, in the second half of the year, 14.9%, which was 380 basis points up on the period prior to acquisition, so well on the way to our 17% medium-term target. That was really achieved by us now being at a run rate of $27 million of cost synergies relative to our initial target of $30 million. So really pleased with how the integration of ESCO has gone. Turning now to oil and gas, then, as I said, more challenging market conditions after a solid first half to the year. We saw E&P's budgets expired, and them turn to a real focus on cash generation as opposed to growth. And what that meant was that there was significant excess capacity in the North American frac fleet, which depressed demand for our products in that market. That left orders down 30% year on year, revenues down 25%, and operating profits down just over 60 million in the year to 37 million pounds. Of course, as we normally do, we responded to those conditions and took proactive action to manage our cost base with a 35 million pound cost saving programme, which we started to see the benefits of coming through in the fourth quarter this year. Given those market conditions, we've looked at the carrying value of our oil and gas assets, and we've taken a non-cash impairment charge of £546 million, which really reflects the uncertainty around the timing of the market recovery, notwithstanding the fact that we do believe in the quality franchise that we have there, with a market-leading position in frac pumps and flow iron. Turning to cash, a strong cash performance once again. Operating cash flows of £408 million in line with last year. That really reflects the fallout of the flow control business that we sold in the year, the weakness in oil and gas offset by, once again, very strong cash performance from both minerals and ESCO. Looking at net debt, on a pure financial basis, net debt reduced by about £155 million in the year, reflecting the benefits from the success, or the proceeds from the successful sale of Flow Control. And on a reported basis, net debt is actually higher, but that reflects the new accounting standard IFRS 16, which required us to bring about £185 million of leases and disclose those now within our debt figure. So overall, if I look at the year, then while challenging conditions in oil and gas markets, we responded positively to that with our restructuring actions. And once again, the quality of our mining businesses has been underlined with strong revenue, profit and cash generation growth.